Thank you very much, and we'll launch straight into it. What I thought we'd do by way of introduction is get each of our panellists to introduce themselves and talk about their business, and specifically talk about the model that they're using for their marketplace lending, because that particular phrase covers lots of different models, as we know. So I really wanted to break it down in terms of borrower demographics, investor demographics, and the style of platform. You know, have we got loan selection or automated selection, fractionalised loans, etc. So if I could just go down the line and you introduce yourself and discuss that, that'd be great.
Sure, thanks Julie. I'm Neil Roberts, I'm the founder and CEO of Harmoney. We are Australia's largest marketplace lender. And to tell you a bit about the New Zealand business, we were the first to get a specific peer-to-peer license about 3 years ago. We've been live just over 2.5 years. We run a dual-sided marketplace, so fully fractionalised consumer loans with about 15,000 individual retail investors plus wholesale money on one side and personal loans on the other. Cumulative lending to date, we're around $420 million Kiwi. And we set ourselves a target of doing 100 million in the first 12 months, and we set ourselves a target of doing 300 million by our second anniversary, and by the time that we're 3 years young, we will have done $500 million. We have been live in private beta, and private beta is really just tinkering under the bonnet, actually doing live deals, testing our platform, testing our credit, license on both sides of the platform by ASIC, and we've been that way for 10 months. And just last week we have gone out of private beta and launched specifically in Brisbane, and so far over a week it's been okay, it's going well, and we've one thing left to learn, and that is, can we acquire customers at a reasonable rate? And one of the focuses of today is profitability of platforms, and I'm pleased to say that we are hovering around profitability, which has been an absolute focus of ours for the last couple of years, and that's Harmoney.
Hi everyone, my name is Alex Benjamin. I'm the founder and CEO of Lendful, a Canadian online lender. We provide consumer loans up to $35,000 on a 6-month duration through to 5 years. I actually am Australian. I grew up in Melbourne but worked for Macquarie Bank in Sydney for about 8 years. Got venture capital funding 2 years ago to launch Lendful in Canada, based in Vancouver. We've got an office in Montreal and Toronto. We built a demand-first platform, so we really tried to understand what do customers actually want, and does a marketplace actually matter to the borrower. And actually what we found is that we found there was immense demand, and we actually secured a bank facility early. So we have up to around $50 million of access to debt that we're able to lend out. We've got a growing team. The regulatory situation in Canada is a little bit more stringent. It's actually not very scalable to use the real marketplace model. But I think Neil can probably attest to this in some ways as well, is that being on balance sheet allows you to be profitable much faster. And as we're seeing, investors really want to see that. And so that's what we're demonstrating. We're growing very quickly.
Okay, hello everyone. Thank you for being here. My name is Mattias Karnell. I work at Maneo, which is Japan's largest loan-based crowdfunding platform. We've been around since 2008, and we've done about 65 billion yen to date, which in US dollars is about 550 million to date. And what we basically do is we are quite unique, I'd say, from a global perspective, in the sense that the overwhelming majority of our investors are retail investors. And yeah, we have thousands of active retail investors. We're not taking institutional money for the time being. And we have a bit of a hybrid model, you could say. We lend as a money lender in Japan. We lend on our balance sheet, but we don't take the risk of default. That's basically borne by investors, in the sense that investors are sort of like limited partners. They invest in so-called loan funds on our platform, and if that venture goes well, that's to say, if we lend money and we get the money back, they get a share of the profits. If we lend money and the borrower defaults and we liquidate the asset and we can't recover all the funds, then we don't bear that loss. That loss is passed on to investors. So we take the good aspects of we don't take deposits. We take the good aspects of being a bank and an asset manager. It's a pretty unique model, I'd say. And we're quite profitable. We take quite a nice spread. So, thank you.
My name's Richard Williamson. I work in corporate strategy at CreditEase, which is a Chinese P2P and wealth management business. Not well known outside of China, but known within China. And similarly to Maneo, ours it's a genuine P2P business. Our founder and CEO started the business 10 years ago, doing student loans out of his own pocket, and the business has grown since then. So across the P2P and wealth side of our businesses, we have around 45,000 staff now. We have about 20,000 loan origination staff, so we do originate loans online, but still have a substantial offline or physical presence in around 250 cities. And the investor side are predominantly retail investors. The credits are predominantly unsecured consumer loans, but we really operate anywhere from rural microfinance up to SME leasing. And last year we did around $4 billion in new loan originations and around $6 billion in wealth product.
Great, thank you very much. So what I wanted to understand, in Australia there's been a bit of discussion this morning regarding, you know, the margin that the larger banks sort of take between the amount they have on deposit and what they, you know, pay out in lending and so forth. And also, I suppose the sort of underfunding in terms of retail deposit was spoken about in the ANZ talk as well. But I wanted to understand from the international perspective, what were the sort of ecosystem gaps that you felt your particular businesses were driving towards and taking advantage of, and how that might translate into the Australian market? If again we could maybe just go down the line and see how that works.
Sure. Our key learnings are probably threefold. The number one is that consumers have a view of their bank, and banks are well known, in many ways very much trusted, but certainly for a personal loan product, we believe there's a preference to actually use an alternative lender. And the gap that we filled, coming to number two, was actually making it easy, confidential, and 24/7. And I suppose the third learning is we will only grow, and alternative finance will only grow, if we really tap into what customers want and what customers absolutely need. And I know I'm stating the obvious there, but online it's brutal, it's ruthless. We've only got so much time, and we're actually time poor and a little bit paranoid online. So it really is tapping into a means of marketing that consumers love. And if you get all of those three things right, that's certainly been our learning from New Zealand. Yep.
In Canada, the banks are very, very slow, and that's something you hear internationally, but in Canada it's sort of an exception to the case. If you want to get a credit card, it's a 1-hour appointment. You've got to roll up at the bank with tons of documentation, and you have a terrible customer experience. And so really the opportunity for us is to acquire customers in a really easy and seamless way. So the fintech aspect is actually very attractive to many Canadian borrowers. A big factor for us too is customer acquisition costs. And we find that, you know, the bank that we've partnered with are actually able to sit there and tell their board now that they've been able to shut down a branch because of their partnership with us. And so come back to customer acquisition costs. Can online businesses acquire customers more cheaply than the banks? The banks still have the big overheads of the bricks and mortar, and that's still a big factor that I think fintechs, can really play at it. It's a big insecurity for banks, what their overheads are, and I think it's forever going to be a theme, and I don't think anyone should ever forget it. So for us, it's definitely, you know, that customer acquisition cost is a big focus for us, and we can do it cheaper than the banks can.
Okay, so I guess our main value proposition for Japanese businesses, we only lend to corporate borrowers. Our main value proposition is that we provide them services which they either don't have access to or that are too slow for them. So those who are underserved by the banking sector amongst Japanese companies include those that have not been around for 3 years or less. Japanese banks won't even conduct due diligence on you if you don't have 3 years worth of financial statements. Or if you're in the real estate field, which is our specialization, if you just want to acquire property, do a quick flip and sell it off to someone else, Japanese banks will very rarely lend you money for that, because that is what caused a gigantic bubble in the 80s. People getting a loan on land, holding it for 6 months, selling at an inflated price. Banks are still Japan is still reeling from that 25 years later on. So banks are they don't like development deals and quick flip deals. And also, we even serve those corporate borrowers who have got a senior loan from a bank. But banks, they only lend 60-70% of the value of a property. So, we sometimes provide senior debt, sometimes we provide mezzanine as well. So we provide products to those customers who are either completely underserved by the banks or only partly serviced by the banks.
And I think in China, it's increasingly looking like the sort of market that my fellow panellists have discussed. So 10 years ago, when the business was launched, bank credit growth is centrally controlled in China. There was a structural crowding out. State-owned enterprises got all of the available bank credit, so there was nobody lending to consumers and SMEs. And equally on the other side of the equation, there weren't many wealth products through the banks. So I think 10 years ago, Founder had that benefit of really launching into a market where there was an absence of lending and an absence of deposit products. Over that period, it's a lot of competition, so I think at its peak there were 3,000 or 4,000 different P2P lenders in China, and that number's coming down as the sector's regulated. So now all of these same issues around service quality, a great customer proposition, being able to acquire customers at a sensible cost, they're all of the sorts of things that are now increasingly important to us that were less so 7 or 8 years ago.
Actually, that's really interesting for the Australian marketplace, because of what I was hearing is this idea of, the overhead costs, the cost of acquisition, the bricks and mortars. The banks here did this whole, back in the 90s, get rid of bricks and mortars, but then they've gone back into that world, and now I think are going to have to relook at that. I think also, Australians would probably perceive themselves as being fairly well serviced in the lending space, but even in that property market now, we're seeing a tightening of credit standards, particularly for investment style properties, perhaps akin to what you sort of saw in Japan, perhaps not as far as that yet, but you can certainly see that that's a trend with the traditional banks, and why that then in the Australian space opens up even more the fintech space in that sort of arena. What I did want to get to, though, if we could, and perhaps a bit more of a curlier question then, was actually on the profitability side, because there's been a lot of commentary that marketplace lending in its current form may not be around to stay because it's not as profitable, or it's still sort of got low profitability. So I'm just wondering how you're seeing the monetization of these services and growing your platform and reaching that broader number of customers. Might start at the other end, perhaps just for a bit of variety.
Yes, so our, we have online and offline P2P businesses now. Online P2P business IPO'd on the New York Exchange in December 2015, year-end high. So our profitability of that platform's a matter of public record, and we have an earnings announcement coming up. And really the drivers for that business are the same as for any of the other listed peers: customer acquisition costs, loss rates, and so on. But across the broader business, what became apparent 5-6 years ago was that in China at least, there was an abundance of funding and really a shortage of high quality loan assets, and particularly as the number of P2P platforms grew through 1,000, 2,000, 3,000, 4,000, a lot of competition for quality loan assets. So at group level, the right decision was taken then that we have all of these clients that want to invest. We cannot find enough loan assets for them, and that was the genesis of launching the wealth business, which is now 50% larger than the P2P business in terms of overall sales. So I know it's not so easy to do in a range of markets to pivot or expand from a marketplace platform to a wealth platform, but that's been, at least for us in China, a significant profitability driver over and above the core P2P business.
Okay, so in the case of Japan, Maneo actually started out as, so basically Maneo lent from 2008 to 2011 to consumers, to individuals. And Maneo did that from 2008 to 2011, and during that time, Maneo was pretty deep in the red. It did $4 million over those 3 years, and the company actually got bought out, to be honest, by my current boss. And since then, we shifted to lending to corporations, those who are, to be honest, willing to pay between 12 to 15%. Those are the bottom of the lending or interest rate pyramid. And yeah, we've been profitable ever since. And I think another reason for that is due to the relatively low overhead that we have. I mean, we've done what we've done so far with about 35 staff, whereas you have big fintech platforms that have hundreds and hundreds of staff, and staff don't work for free. So, so I think, and another reason why I think we've been quite successful and profitable is that we've had no loss on investment since my current boss took over in 2011. And in the case of Japan, I mean, I may not be so well known, but failure is pretty much completely unacceptable. And that's another reason why you don't have entrepreneurs, more of a general trend. But if you fail once, especially in an industry like ours, you'll lose, people will lose complete faith in you, and people will never come back to your platform. So we actually meet all of our borrowers, and which I think is not maybe that common in our industry, where people who have to scale up, you can't meet 50,000 borrowers, but we meet our borrowers and we make sure that they're going to return our money, because it's not our money. And we've worked hard to establish the trust that we've earned from our investors who, Japanese are very risk averse. I mean, they're used to getting 0.05% on their term deposits, and they're getting 5 to 8 with us. For them, it's too good to be true, but thankfully, it's not too good to be true. So we're working hard to keep that trust and to stay profitable.
I think this question's about the headwinds. I think one of the key things for us is not to get too anchored to one particular model, and I think really, when we're out raising equity capital for the business, one of the things, deal with a lot of North American VCs is it keeps coming back to profitability, lifetime value, really understanding how long you can be making money for with a client. What do repayments look like? How soon will this money be coming back? And how profitable is each client? And so from the get-go, we've been very focused on what's the most profitable model. And for us, on balance sheet, by far and away, has allowed us to be, on the trajectory to profitability. For most platforms, you can be making, just from what I've seen, sort of, somewhere between $5,000 and $10,000, if not more, with one customer, as opposed to the marketplace model where you can only charge an upfront fee at the start. You're only making a small fee in the back end. And to scale and really get the volume that you need, you've got to be making, from what I've seen and seen other models, $200-300 million in terms of volume to get to break even. Whereas an on-balance sheet model is, a tenth of that. So I think investors want to start to see, they do want to see profitability. And I think to stay in business, you've got to be smart and thinking, well, marketplaces are interesting, but what's the model that really makes sense for this particular market?
I think starting a platform, you have some real challenges. You've got to pour a lot of money into tech. If you're on balance sheet, you have to support the balance sheet with capital. And there's no other time that's more expensive to acquire customers as when you started off. So I think it's a tough ask, and no wonder investors are looking towards platforms to be at least pointing to profitability. From having said that, you should know that at the very start. And at Harmoney, we now have 14 different lines, substantial lines of income, and we work very, very hard to produce that. So as we look forward into the next year, we should achieve 100% in our revenue growth, and that's disproportionate to our lending growth. So I think the models need to evolve, but I'd also hasten to add, we started Harmoney and didn't think the world needed another lender. We thought a better place to lend and borrow, and we still think that, and we're determined to try and create that in the future, no matter how hard it might get, and that might be some sort of hybrid perhaps that we haven't seen yet, and certainly that's our belief and where we're heading towards.
So they just have to put a bit of time and effort into it, basically, is what you're saying.
Yeah, absolutely.
Look, we did get one question, and I think I might direct this initially at you, Alex, if you don't mind. They wanted to know, can you share your range of average customer acquisition costs and how much of a scale effect are you expecting from growth? I mean, I'll open it to the panel, but perhaps I could start with you.
Great question. It's the first thing I focused on when I set up the business. My early stage VC basically said, you've got to speak to every lender globally. So I spoke to 182 people in 2 weeks. And I just plotted customer acquisition costs globally. So this is going back 2 years ago, and I still follow it. But in the US, I was seeing sub $50 for Lending Club and Prosper. Right across Asia Pacific, you'd see sort of $500 to $800, even $1,000. It really depends. It's obviously a volume game. So the more volume you get, the lower your customer acquisition costs are, generally speaking. There's also, whether you partner or whether you go direct to consumer, and so direct to consumer marketing costs can skyrocket to a couple of $1,000s. If you partner, you can be a lot more, have a lot more control over those costs, and you can see them sort of, sub $500. In the UK, so I remember meeting the guys at Zopa. They were the original sort of marketplace lenders, and they were like, oh, if it's not £3, it's £2. So it was at the other end of the spectrum. And they really used PR to sort of leverage the marketplace model. So I think, as a rule of thumb, I think we work on the basis of around sort of $500 to $800 for customer acquisition costs. But I'm always testing, and I'm always trying to find a cheaper way. And as you get bigger, and I'm guessing you'll tell me this as well, that it'll drop from there.
Is that your experience?
Yeah, it kind of has to be. So we opened the doors in a fit of enthusiasm, and I think in our first month we were pushing $2,000 and wondering how long the doors would keep open if we didn't actually find a new way. So nothing like a kick in the pants to learn something new. And as we speak today, we certainly obviously take a different view to our repeat book than new, but we've brought that down dramatically, and we are $600 to $700 probably for a brand new customer. But obviously we have a high incidence of repeat as well. But certainly there's a very clear trend to where marketplace lenders need to go, and you need to let go of the more traditional means of acquiring customers and move a lot more into the pull model, actually attracting, engaging customers in your mission, if you like, without paying for advertising and without paying Google, who actually are evil, for every customer that you get. So yeah, absolutely, it's an evolution.
Can I just add to that with repeat funding is obviously a great way, and the banks know this, by offering you credit cards and an increased credit limit, you are not paying CAC again, and you're constantly increasing your profitability. So it's something that I think a lot of models try to adopt, a push funding model, and you'll probably see more of that in the next 5 years.
I mean, with our companies, we have 2 types of customers. You have borrower customers and the investor customers. When it comes to borrower customers, we don't actually do any direct marketing to borrowers at all in Japan. Most of our borrowers are repeat borrowers, and for those who are not repeat borrowers, they're mainly, basically the younger staff. They do cold calling, call, go visit people, and that's the main cost. When it comes to investors, until around June or so last year, our marketing budget was 0. So we basically held seminars that were hosted at our office, like twice a month, and word of mouth is how we grew our registered user base to about 35,000. We've started leveraging marketing a little bit more. It's a small budget, and we've seen the effects of that. But word of mouth is quite amazing. I mean, if you can get by without, spending a huge amount of money on marketing, which is really hard to avoid in places like the US and the UK and Australia, then you can be even more profitable.
Well, I think I've just got time for one question, if there's anything from the audience at all. I think we've got time, briefly. I did want to just touch on that point again about, the customer as the investor, not just the borrower. And Richard, I think this sort of goes to what you were saying in terms of the model you're building and working in at the moment, in terms of really focusing on that investor side. How do you see this sort of fitting into their asset allocation models and how they're adapting to peer-to-peer lending?
Yeah, so the way the business has evolved over time, now for every dollar in P2P, we write $1.50 in non-P2P, and originally the catalyst for that was we just didn't have enough P2P product. So it means we look at the financial metrics a little differently. So speaking about customer acquisition costs, we have those on both sides. So we originate loans either online or through these 20,000 loan originators, and there are different acquisition costs there. And then we match it with investors as well. So we have 3,000 financial advisors in the Australian vernacular. So we have acquisition costs there as well. So we look at the metrics a little bit different, but in terms of overall profitability, the economics on the wealth product we sell, which could be mutual funds or private equity venture capital funds, is sort of very attractive, very different financial profile. So at least in our market, it's been terrific for overall group profitability and a diversified stream as well.
Well, thank you very much, gentlemen. I really appreciate your time. Thank you.
Thanks.
Thank you.